Hello and a very warm welcome. We've put this session together with the specialists over at My Tax Accountant to talk about something that's on every landlord's mind: how to legally and effectively pay less tax. So, let's dive right in. Does this feel familiar? You've done all the hard work, finding tenants, managing the property, only to watch a massive chunk of your hard-earned rental profit vanish into what feels like a tax black hole? You're not alone. The UK tax system for landlords is notoriously complex, and if you don't have a solid strategy, it can seriously damage your returns. But that's exactly why we're here today. We're going to cut through that complexity. With the expertise of My Tax Accountant, our goal is to give you clarity and the confidence to navigate the system like a pro.
Right, before we can talk about solutions, we first need to get a really clear picture of the challenges. The tax landscape has changed a lot, and for the 2025/26 tax year, there are some key taxes that every single landlord absolutely has to be on top of.
So you've got the usual suspects: income tax on your profits, capital gains tax when you eventually sell, and of course inheritance tax to think about for the future. But honestly, the real game changer, the one that's caused the biggest headache recently, has been the change to mortgage interest relief. This single rule change means many landlords, especially higher-rate taxpayers, are paying way more tax than they used to. It's made having the right strategy more critical than ever before. Okay, so let's get into the practical stuff. We're going to start with your first line of defense against a high tax bill: claiming every single allowable expense you are entitled to. This is the bedrock of good tax planning, and honestly, it can make a massive difference. The golden rule here is pretty simple. An expense has to be wholly and exclusively for the purpose of your rental business. And as you can see, that covers a whole range of things, from your agent fees right through to essential repairs. Here's a quick pro tip for you. Don't forget that the fees you pay your accountant to handle your rental tax affairs, yep, that's a deductible expense too. A lot of people miss that one. The key to all this: meticulous record keeping. Now, here's where things can get a bit tricky, and it's a place where a lot of landlords trip up. It's the difference between a repair and an improvement. A repair, like fixing a broken-down boiler, brings the property back to its original state. That's an expense you can claim against your income right now. But an improvement, like building a brand new extension, adds value. That's a capital cost, and you can only claim it against your profit when you eventually sell the property. Getting this distinction right is absolutely crucial to staying on the right side of HMRC. And here's another quick tip for you. If you add up all your expenses and they come to less than £1,000 for the year, you can choose to use the property allowance instead. It's simple. It just lets you receive £1,000 of your rental income completely tax-free. No need to itemize all those little receipts. For landlords with low outgoings, it's a fantastic hassle-free option. Okay, let's move on to what is quite possibly the single biggest, most impactful decision you can make as a landlord, and that's all about how you actually own your properties. Believe me, this one choice can completely change your entire tax situation. Let's think about it. If you own a property in your own name as an individual, your rental profit is just added on top of all your other income, like your salary. For many professionals, this can easily push your total income over that $50,271 threshold, meaning you'll be paying tax at a pretty hefty 40% on every pound of profit you make above that. Now contrast that with owning your properties through a limited company. The company's profits are hit with corporation tax, which for the 2025/26 tax year is 25%. You can immediately see the difference, right? That's a huge potential saving right off the bat compared to that 40% personal rate. So let's properly break it down. Owning as an individual is definitely simpler, no doubt about it. But you're facing those higher personal tax rates and that restricted mortgage interest relief we talked about. Now, in a limited company, you get the lower corporation tax rate, and here's the real game changer: you can deduct your full mortgage interest cost as a business expense before tax is calculated. The downside? A bit more paperwork, and you have to think about dividend tax when you take profits out for yourself. But for many, the benefits far outweigh the costs. But stay with me. This next point might just surprise you. Even if a limited company isn't right for you, there's another powerful strategy: joint ownership. If you own a property with a spouse or partner who's in a lower tax bracket, you can split the rental income. This means you can use their personal allowance and their lower tax bands, which can literally save your family thousands of pounds a year. It's a really smart move. You know, smart tax planning isn't just about this year's tax bill. It's about looking at the entire life cycle of your investment. Having a long-term exit strategy is absolutely essential.
Thinking about things like capital gains and inheritance tax right from day one can save you or your family an absolute fortune down the line. So, when you sell a rental property and make a profit, you're faced with capital gains tax. For the 2025/26 tax year, your tax-free allowance is just £3,000. It's not a lot, is it? Any profit you make above that small amount is going to be taxed.
And the rate you pay depends on your other income. Look at the jump on this chart. It's 18% if you're a basic rate taxpayer, but it leaps up to 28% for higher rate taxpayers. And here's the real trap. A big capital gain from a property sale can easily push you from the basic rate band into that higher bracket just for that gain, meaning a much bigger slice of your profit gets taken by the taxman.
But the good news is, it's not all doom and gloom. There are reliefs available that can slash your CGT bill. The most powerful one by far is private residence relief. If that rental property was ever your main home, you can claim relief for all the time you live there, plus the last 9 months of ownership, and that portion of the gain is completely tax-free. It can make a massive, massive difference.
And finally, let's touch on inheritance tax. It's a flat and frankly eye-watering 40% tax on the value of your estate over £325,000. The crucial thing to know here is that while your main family home gets some extra protection, your rental properties are fully included in your estate, which makes your portfolio a prime target for IHT. The good news is you can plan for this. There are strategies like gifting property, using trusts, or even incorporating your portfolio to pass on shares instead of bricks and mortar. But these are complex, advanced strategies. This is definitely not DIY territory, and it's an area where getting expert guidance is absolutely essential to make sure it's done right.
Phew. Okay, we have covered a lot of ground. So let's pull all these threads together into a simple, straightforward action plan. The crucial point is, what should you do now? Here it is, your 3-step action plan. First, review and record. Get organized, meticulously track and claim every single penny you're entitled to. Second, assess your structure. Take a hard look at how you own your properties. Is being a sole owner still the best fit, or could a limited company save you a significant amount of tax? And third, plan for the future. Don't wait. Be proactive about capital gains tax and inheritance tax now, before they become a real headache. Look, I get it. We've gone through a lot of information, and it's completely normal if you're feeling a little bit overwhelmed right now. The rules are complex, they change, but the really good news is you absolutely do not have to figure all of this out on your own. Honestly, getting professional, personalized advice is the single most valuable and tax-deductible expense you can have as a landlord. The experts at My Tax Accountants can look at your specific situation and build a strategy that's tailored just for you. Their contact details are on the screen now. You can call them on 0208-570-8531 or drop them an email at info@mytaxaccountant.co.uk. We really hope this session has given you a clear, actionable plan for becoming a more tax-efficient landlord. For more expert guides and tips just like this one, make sure you hit that subscribe button for the My Tax Accountant YouTube channel. Thanks so much for watching.